Hey everyone, welcome back to the channel. The channel where I break down the principles of value investing to help you invest smarter for the long term. Have you ever wondered what separates a truly great business from a mediocre one? It's a question that every successful value investor from Benjamin Graham to Warren Buffett has obsessed over. Finding a high quality business is the first step to successful long-term investing. But quality can feel like a vague term. How do we actually measure it? Well, today we are going to demystify it. We will break down 5 simple yet powerful financial criteria you can use to identify a quality business. These aren't based on gut feelings. They are based on the numbers that tell the real story of a company's performance. And the best part? I'll show you how our platform Let's Value Invest, or LVI, automates this analysis so you can do it yourself. So let's get started. First up, we have gross profit margin. Think of this as the purest measure of a company's profitability. It tells you how much profit a company makes from each dollar of sales after accounting for the direct costs of producing its goods or services. A consistently high gross profit margin is a strong indicator of a durable competitive advantage, or what Warren Buffett calls a moat. It means the company has pricing power. As a quality-focused investor, I generally prefer businesses with a gross profit margin above 50%. The higher the better. Think of asset-like software companies like Microsoft or subscription businesses like Adobe. Their cost to sell one more copy of their software is almost zero, which leads to incredibly high gross profit margin. This is a hallmark of a scalable, high-quality business. On the other hand, I tend to be cautious with businesses in highly competitive, low-margin industries like general retail or maybe airlines. These companies often have to fight for every penny of profit and just don't have the pricing power of their high-margin counterparts. So the first thing to look for is a company with stable and high gross profit margins over many years. It's a classic sign of a quality business. Alright, next up, we need to know if management is skilled at using the company's capital. For this, we'll look at a powerful metric, return on capital employed, or ROCE. So what exactly is capital employed? Think of it as the total pool of money the company uses to run its business. It's the sum of all the money from shareholders, which is equity, and all the money from lenders, which is debt. This is the total funding management has to work with. ROCE tells us how efficiently they are using that capital. It answers the question, for every dollar of capital invested in the business, how many cents of operating profit does the company generate? Let's take a simple example. Imagine two companies, Company A and Company B. Both companies use $1 billion of capital to run their operations. Company A's management uses that $1 billion to generate $200 million in operating profit. So their ROCE is 20%. Company B's management, using the same amount of capital, let's say only generates $50 million in operating profit. So their ROCE is simply 5%. So which company's management is doing a better job then? Clearly Company A. They are 4 times more efficient at turning capital into profits. That's why a high ROCE, say above 15 to 20%, consistently shows that management is skilled at their job. It's a key measure of operational efficiency. Our third criterion is arguably the most powerful concept for long-term investors, and it comes straight from the playbook of none other than Warren Buffett. It's about judging management's skill at reinvesting profits. Think about it this way. When a company makes profit, it has two main choices. It can give that money to you, the shareholder, as a dividend, or it can retain those earnings and reinvest them back into the business. In his 1983 shareholder letter, Buffett posed a simple question: when should management keep your money instead of giving it back? His answer was what he called the $1 test. And the test is this: for every dollar of earnings a company retains, it must create at least $1 of market value for its owners over time. So, how does a company pass this test? How does it convince the market that a dollar in its hands is worth more than a dollar in yours, that is the shareholders? By proving it can reinvest that retained dollar at a very high rate of return. And this brings us to the engine behind the $1 test. Return on incremental capital employed, or ROICE. While ROCE tells us how well management uses its existing capital, ROICE tells us how skillfully they invest new capital. It measures the direct profit generated from those reinvested dollars. Let's go back to our example. Imagine this time two companies, Company C and Company D. Both companies decide to reinvest 100 million of their profits from last year back into the business to fund new projects. Company C's management invests that 100 million and generates an additional 25 million in operating profit this year. That's a 25% return on incremental capital employed. For every new dollar they put in, they got 25 cents back in annual profit. They are creating enormous value. Now Company D also reinvests the same 100 million, but their projects only generate an additional 5 million in operating profit. So their ROICE is just 5%. They are simply destroying value compared to what a shareholder could likely earn elsewhere. Which company is more likely to pass Buffett's $1 test and be rewarded by the market? Company C by a long shot. This concept is so important that Warren Buffett refined it in his 1992 letter with this famous quote: leaving the question of price aside, the best business to own is one that over an extended period can employ large amounts of incremental capital at very high rates of return. That's the magic combination. A high return on incremental capital employed is the true engine of compounding. It's the operational proof that allows a company to pass the market's $1 test. And it's what separates good companies from truly wonderful long-term investments. And if you want to dive deeper into how return on incremental capital is calculated on the LVI platform, just look for the question mark icon next to the metric. Clicking on it will open up a detailed tooltip with a complete step-by-step example. Our fourth criterion is all about financial strength. A quality business is not drowning in debt. It's financially robust and can withstand tough economic times. Warren Buffett has always been extremely wary of debt, especially for non-financial companies. His philosophy is very simple. A truly great business shouldn't need to borrow heavily to grow. Its own operations should basically generate more than enough cash. He famously summed up his view on leverage with this line: if you are smart, you don't need it. And if you are dumb, you shouldn't be using it. Too much debt makes a company fragile. It takes away its margin of safety. A small business problem can quickly turn into a major crisis if there are large interest payments to be made. So, how do we measure this? A simple way to check is the debt to operating cash flow ratio. This ratio tells you how many years it would take for a company to pay off all its debt using only the cash it generates from its operations. Obviously, a lower number is always better. For example, if a company has a ratio of 2, it means it could theoretically pay off all its debt in just 2 years. That's a strong position. If the ratio is 10, it would take a full decade. Personally, as a quality-focused investor, I look for a ratio of less than 2. Worst case, I might consider a company with ratio up to 3. But for me, anything above 4 definitely becomes an easy pass. A business with low debt is less risky and has more flexibility. It's a sign of a business that isn't just surviving but thriving. A business Buffett would probably admire. Our final criterion is the reinvestment rate. This tells us how much of its earnings a company is plowing back into the business to fuel future growth. And this brings us full circle to that powerful idea from Warren Buffett we discussed earlier. In his 1992 letter, he said the best business is one that can employ large amounts of incremental capital at very high rates of return. Let's break that down. Employing large amounts of incremental capital is exactly what the reinvestment rate measures. A high reinvestment rate means the company is doing just that. It's taking a large chunk of its profits and putting them back to work. This is a fantastic sign if it's paired with the second part of Buffett's rule, at very high rates of return, which we already checked with return on incremental capital employed. That's a mouthful. A high reinvestment rate indicates that management sees abundant opportunities for expansion and has a long runway for growth. It's a signal that the company is in growth mode, building a larger, more profitable enterprise for the future. Personally, I look for a reinvestment rate in the 40 to 50% range, as long as the return on incremental capital employed is also lucrative. This tells me the company has great opportunities and the skill to execute on them. So we look for healthy reinvestment rate combined with high returns on that capital. That is the recipe for powerful long-term compounding. So we have covered our 5 key criteria for identifying a high-quality business. Let's quickly recap what we are looking for. We want a high gross profit margin, high return on capital employed or ROCE, high return on incremental capital employed, that is ROICE, low debt to cash flow, and a healthy reinvestment rate. But looking at a single number for just 1 year isn't enough. We need to see the trend and the big picture. This is where the Let's Value Invest becomes your DIY analysis powerhouse. On LVI, the quality of business section under Key Insights takes these exact metrics and gives you an overall assessment by focusing on profitability, capital efficiency, and financial strength. For each of these criteria, LVI automatically calculates the 10-year, 5-year, and 3-year historical averages and assigns a score out of 5. This process turns complex financial data into a clear, actionable rating from bad to very good. Finally, the overall business quality score is the average of all these individual metric scores, giving you a single powerful number to gauge the quality of the business. Let's now see this in action. According to the Let's Value Invest, Microsoft scores an outstanding 4.8 out of 5 for business quality, earning a very good rating. This tells us that by quantitative measures, Microsoft is an exceptionally high quality business. Here is a quick breakdown of what the numbers reveal. First, profitability. Microsoft's gross margins are consistently high, hovering around 68 to 69% for the last decade. This is a classic sign of a powerful moat and pricing power. Next is management effectiveness, with return on capital employed figures consistently well above 20%, it's clear that management is exceptionally skilled at generating profits. And the return on incremental capital employed is just as impressive, with a 10-year ROIC of nearly 30%. Microsoft has proven it can reinvest new capital at very high rates of return. This is the true engine of compounding. Then we have financial health. Microsoft boasts a fortress-like balance sheet. Its debt to operating cash flow ratio is consistently below 1x, recently hitting a low of 0.41x. This means the company could pay off its entire debt in less than 6 months using its operating cash. That provides immense flexibility. And finally, its growth runway. Microsoft maintains a very high reinvestment rate, recently as high as 89%. When a company combines a high reinvestment rate with a high return on incremental capital employed, as Microsoft does, it's a powerful signal of a long runway for growth. It shows management sees abundant high return opportunities like artificial intelligence and cloud computing, and is aggressively deploying capital to capture them. So there you have it. By using those 5 simple criteria, you can systematically analyze a company's quality grounded in financial data. And with the LVI platform, you can see exactly how these metrics are scored and rolled up into that final business quality rating, helping you to quickly separate the wonderful businesses from the mediocre ones. As a quality-focused investor, I generally look for businesses with a very good quality rating, which means they have an overall score of more than 4 out of 5. And this simple benchmark helps me focus my attention on only the best of the best. If you found this video helpful, please hit that like button. And be sure to check out my value investing platform, Let's Value Invest or LVI, to run this kind of analysis yourself, and I will leave its link in the description below. Don't forget to subscribe for more videos like this. Thanks for watching, and I will see you in the next one.